Steve Eisman, portrayed by Steve Carell in The Big Short, was one of the few investors who predicted and profited from the housing bubble in 2008. And recently he was back on CNBC and Bloomberg to discuss his prediction for the end of the stock market crash. The US market retracted about 25% in 2022 and has since then been on a consistent rise. But will it last? And what indicators is Eisman watching to stay on top of his investments? He also revealed his next big stock market bet, which might surprise you because I haven't heard anyone talk about this whatsoever. But first, the big question that everyone has been wondering is, have we seen the bottom of the stock market?
If the Fed stopped raising rates, I don't think there's any question there would be a pretty sharp rally at that point, and then people would really focus on what's going to happen to the economy.
Eisman believes that it's pretty likely the market would experience a short-term surge if the Fed stopped raising interest rates. And that's really because of two key factors. Firstly, how interest rates impact the market, and then also just generally how the market functions. Interest rate rises are bad for businesses because it raises the cost of debt, making them less profitable. It also reduces consumer spending, which reduces business revenue, again, making them less profitable. And it also reduces the relative value of stocks compared to other investment opportunities, which have seen their returns rise with interest rates.
As long as rates stay high, the old paradigm of, what was it called? TINA, there is no alternative. It's not true that there's no alternative. I mean, yeah, when we tell our clients you can have something at very short-term duration with a yield of 4.5% with zero risk, they're happy to park some cash.
Eisman is referring to something called TINA, which stands for there is no alternative. He's referring to the last decade of near 0% interest rates, which gave investors basically no choice but to invest heavily in stocks, pushing them higher. Today's environment is completely different.
Yeah, I mean, I'll tell you one thing that I've been doing lately, which I haven't done in 15 years. Our group's been actually buying bonds. At least some bonds. And when we have cash, we either park it in a money market fund that yields over 4%, shocking, or we even buy, 3 month treasuries with a yield of 4.6%. I'll say it again, 4.6%.
You can get a 4 to 5% return with almost no risk, and that means stocks have become relatively less attractive when compared to other investment opportunities. So if interest rates were to stop rising or they went down for a period of time, that would certainly be a strong catalyst for a stock market rally. But even if that did happen, Eisman is skeptical about how long the market would increase before coming back down again.
And then people would really focus on what's going to happen to the economy. And, if the data points start to get very bad, then I think the market will focus on that.
Markets are generally focused on what they expect to happen in the next 6 to 12 months. So whenever there is new information or new data that comes out and contradicts the current expectation, you generally see the stock market move sharply either up or down. For example, if the Fed chooses not to raise rates for a second month in a row, that likely will drive the stock market up. But after that, the new expectations will be that the economy is on a smooth recovery. And if that doesn't come to fruition, the market would likely react very negatively. One thing I'd like to see have a sharp increase would be my subscriber count. No, but seriously, I'm trying to reach 200,000 subscribers by the end of the year. So if you'd like to help me achieve that, the best thing you can do is just go below this video and hit that subscribe button. And unlike the New York Times, it's completely free. And let's be honest, the content's probably better too.
Did you feel better last week, Steve, with inflation kind of moderating with both the CPI and the PPI, or didn't change anything in your view?
I mean, a little bit, but I think it's just one data point. So we'll see. I mean, yes, a little better. It's unclear to me what's going to happen to the economy going forward. I mean, I think there's definitely a slowdown. I think it's way too early to talk about a recession, even though financial conditions have tightened somewhat, but it's not even clear how much they've really tightened.
While a rate pause or cut would certainly be a strong catalyst for the market, Eisman doesn't think that investors should expect this to happen. And this is because inflation, which has been the main reason for the Fed raising interest rates, doesn't seem to be coming down all that much. Headline inflation in the US was just 4% last month, down from over 9% 12 months ago. But if you look closely, particularly at core inflation, it's proving to be a lot stickier. Core inflation was a massive 5.3%, and it was only a slight decrease from the month before. But with the fastest rate hike period in US history, why isn't core inflation coming down very fast? Well, it has a lot to do with another vitally important economic indicator.
Do you, at this point, think that we're going to, that 2% number, is that locked in stone for inflation? Would you settle for 3? Do you think the Fed would settle for 3? Is 3 that bad?
I don't think 3 is that bad. I think 2 will be very, very difficult given how much wages are still going up.
Getting inflation into the 1 to 2% healthy range will be difficult because the labor market is still extremely hot. Since the beginning of 2022, the unemployment rate has been at a record low of 3.5%, which is actually the lowest rate in over 50 years.
What I've heard from some companies, very large banks that really have the best data, that consumer spending has really slowed in the last couple of months. The consumer is still relatively healthy because everybody's employed. So, you're not going to see like a real deterioration in consumer credit or anything like that until people start losing their jobs.
While costs for consumers have risen a lot, and now the cost of debt too, the big spending cuts needed for core inflation to really slow down won't likely come until unemployment starts to rise.
The Fed, from what I've noticed, is really focused mostly on wages at this point. Now, if unemployment would start to go up or wages were really going to slow in terms of wage increases, I think that would please the Fed the most. What's interesting about this period is that, at this point, after the Fed had raised rates so much, wages would already start to come down. But because the labor market is so tight, because of the ramifications from COVID, it's going to happen much later.
The pandemic has had way more unexpected consequences than anyone could have imagined, and one of those impacts has been on the labor market. According to analysis by Harvard Business Review, total work hours in the US fell by 33 hours per person per year between 2019 and 2022, and while some of this is due to fewer people working full stop, most of it is due to people simply reducing their hours. So there's just too many employers chasing too few employees, resulting in some of the strongest wage growth in years.
If rates stay high, I think that is going to happen because I think Volcker, Freudian slip. I think that Powell is petrified of doing what Volcker did, which was stop raising rates, cut them a little bit, inflation soars, and he has to go to 17%.
Paul Volcker was the Federal Reserve Chairman during the last significant inflation crisis of the 1970s, and the mistake that he made was cutting interest rates too early. In hindsight, rather than just waiting for inflation to begin declining, he should have persisted with rate hikes until inflation was back inside the target range. The cost of this mistake, of course, was a second more violent inflation wave that required double-digit interest rates and a deep recession to fix. So how would Eisman structure a portfolio in this environment? And what's this huge new investment that he's been focused on?
And the other concept that I think is going to come back is what I'd call risk-adjusted returns.
Risk-adjusted returns coming into vogue. What does that mean specifically?
Risk-adjusted returns means how much return are you generating given every unit of risk? There's mathematical ways to figure that out.
I thought all investors... I thought that was.
Are you kidding? People haven't focused on that in the last 10 years. You have been paid to take as much risk as possible.
Okay.
So that concept, which was in vogue for a very long time, people have just stopped paying attention to it.
Most of the 2010s could be categorized as a period where taking additional risk paid off. Companies that were not profitable yet, not a proven business model yet, were able to survive for long periods of time because capital was basically free. They could borrow money at rock bottom interest rates, and they were selling equity at sky high stock prices. And that ultimately led to a huge amount of innovation and also the birth of a lot of business models that just wouldn't exist in normal environments where they can't get access to extremely cheap capital. That has now changed. Capital is more expensive, and so high growth tech isn't likely to outperform anymore.
The large cap mega companies, I think, are investable for a very long time. But after that, it's unclear. And I think, if anybody gave me their money today, for example, I wouldn't be so overweight tech.
Eisman would stay away from building a tech-heavy portfolio for the time being and instead be much more diversified. Diversification across industries, asset classes, countries, currencies, business models, or other dimensions to help reduce unknowable risks. It can be really difficult to predict which industries are going to face significant head or tailwinds over the next decade, so by investing in a variety of different industries, you're able to reduce the exposure to any particular industry facing a certain set of problems.
I'd be much more diversified. I'd have some, God forbid, bonds.
Eisman would also have bonds in his portfolio. A 1-month Treasury bill is now yielding more than 5%, which means it's a viable place to invest outside of the stock market.
Wait, but it sounds a lot like value investing, right?
No,
People keep predicting
it's not value
the return of value
It's not
investing.
value investing. It's, how much volatility is in your portfolio, how diversified are you? You don't want to be too diversified. What's the beta versus alpha in your portfolio? Those are the concepts that I think are going to start to come back.
Eisman isn't a value investor. He isn't purely looking for undervalued stocks per se, or undervalued by the traditional definition, in great businesses whose cash flows are high and the price of the business relative to those cash flows is low. He has a much more traditional approach to investing, which includes considering things like volatility. Volatility refers to how much a stock moves in a given period, and many investors view volatility as a risk, something that should be reduced. This is distinctly different from value investors who view volatility as simply a reflection of short-term investor expectations rather than any inherent risk in a long-term investment. But when Eisman was talking about how he would structure a portfolio, there was something that he mentioned that stood out to me.
There's plenty of other stories other than tech, such as, for example, has anybody ever noticed that the electrical grid in the United States is pathetic?
On a Bloomberg podcast 2 weeks ago, Eisman began talking about American infrastructure and how he's been making money by investing in the space.
I'll just give you one stock, which hopefully Neuberger won't shoot me tomorrow about. So we've owned a company for a while called Quanta. We have it in most of our portfolios. So Quanta is a company, utilities don't do anything. Somebody has to build the utility. Someone has to manage the wires. Somebody has to bury the wires. So, Quanta, prior to all this grid stuff, used to sell at 10, 11, 12 times earnings. But because all the stuff involving infrastructure, the opportunities for the company have been enormous, so the stock has been revalued.
Quanta is a US-based company that provides infrastructure services such as repairs and maintenance for electric power, pipelines, industrial, and communication industries. And the stock for many years was viewed very unfavorably by the markets.
The utility in California, I think it's PCG, there's a strict liability rule in California that basically says if PCG causes a fire and is only partially responsible, they're completely responsible. The old CEOs of PCG weren't too good. The new CEO was superb. And so she's embarked on this plan to basically bury all the wires of the company. Think about what that means. This is not Rhode Island. This is California. That's a lot of wires. Who's doing that? Quanta.
Quanta is an example of some of the work Eisman has been doing around American infrastructure, which hasn't been developed in a meaningful way in decades.
Now, I remember years ago, maybe like 12 years ago, I had a conference in Hong Kong. So I fly in, the airport's completely new. You could literally eat off the floor. You get into a car, you get onto a highway. It looks like the highway was just built yesterday. You go over a bridge, you go, did they just finish this yesterday? And then, you go to this wonderful hotel, and then you come back to the United States, and you go to JFK, and you're embarrassed. Yeah. Like, this is the United States of America? Like, it's unbelievable. Then you get on the Van Wyck and the Grand Central Parkway, and it's just unbelievable.
Yeah.
At the end of the day, this is just one man's opinion and view on the markets, and I certainly disagree with some of his views on the market and some of his investment philosophies as well. I personally don't make short-term predictions for what the stock market or the economy is going to look like over the next year or so. I really just make one prediction, and that is that over the very long term, the US is very likely going to be a great place for businesses to thrive, and therefore it's a good place to look for investment opportunities over the long term. And maybe the other prediction I make is that in the short term, businesses with deep competitive advantages run by great people will be able to weather whatever short-term noise or short-term problems that are going on, whether it's inflation, stagflation, a recession, whatever it is. If it's a high-quality business out the other side, they'll still be selling products and services at very significant levels to their customers.